Hi, everybody. This is Seth Martin, your host, and welcome to this week's Middle Class Investor. Thank you, everybody, for coming in. Well, we had a kind of a large range week, but market really didn't go anywhere. And I don't know, it just looks kind of undecided. And so we're kind of trading between this 2115 here on the high side and this 2044 on the low side. So we're kind of trading in this range here. But notice that we are staying within this rising wedge that I have drawn. So with that, I'm expecting the market to meander its way up probably to a higher high. Doesn't necessarily have to go to a higher high. If we get to this 2112 or so and roll over, we're likely coming to this area. So there's really not much to do except watch volatility and watch the price action in the market. In fact, let's go to volatility right now, and let's take a look at volatility. I get my chart to come up. I'm having trouble with those, it seems like, lately. So last week we talked about how we were still kind of respecting this line, but we had this descending channel here, and things were getting tighter and tighter, and you can see even this week they're even tighter, and notice we've dropped below the green line again. This is now the 4th time we've dropped below this green line. So does that mean the green line is not valid? Well, I think these are close enough closes. These are more like, think of this green line as a fence, and the market's leaning on the fence. Because really the lines are subjective. You can draw those wherever you'd like, and I happen to draw them where I did. But the market would be maybe leaning a little less if the lines were drawn a little differently. So don't think of it as a breach at this point. Just think of it as the market leaning on this fence. Probably because there's not a lot of room here to move back and forth. So I'm expecting, I said, I'm expecting the market to go up. That's only because we have a higher low and we haven't breached any lows. If we break out of that 2044 area, though, all bets are off. Volatility is probably going to expand in this direction, and the market's going to go lower. Let's look at, I'm going to do something a little differently today, but I'm going to look at a couple of the charts we've been looking at quickly. The interest rate market didn't do a whole lot this week. Bonds rallied a little bit, which caused interest rates to fall. Bonds actually look like they want to rally a little more to me. We can look at a bond chart in a minute. And so we might see interest rates pull down. A lot of times you can look at, let me just draw it on here. You can look at the midpoint of a large candle. So this is a large candle right here. And let me just kind of eyeball the midpoint of this large candle right about there. Sometimes the midpoint of a large candle will act as support. And so we can look at like 1.8%, see if that holds as support. But I don't expect the Treasury yield to go much lower than that. I mean, I'm expecting this low to hold. Although the bond market could make one more high, sometimes as the market's kind of chopping around, the bulls, they've got a little bit more steam and they need some more convincing. So the bulls might want to take the bond market a little higher. But to me, this looks like an initial move up, and this looks more like a pullback. So I'm expecting this area to hold, this area around 1.8, but we'll just have to see if it does. To me, if you went long interest rates, this would be a good place to go long. You might want to wait to break above this area, above the 20 or the 2.25 area, or 2.025, I guess is what it would be actually, to get confirmation of a move out. The euro US dollar, it bounced a little bit. It's really struggling though. That's not the euro US dollar. That's the Swiss franc. So it looks like this 110 area wants to provide resistance, and you can see here. I'll pull up the Williams is in the overbought area and wants to kind of roll over here. So this is just an oscillator. It doesn't mean that it has to. It can actually stay in this overbought area for a pretty long time, just like it stayed in the oversold area here for a very long time. So, but after a long sell like this, you would expect a pretty strong bounce, probably up into this 1.15 area, 1.17, and then we would expect the euro to start to continue its trend downward against the US dollar. Let's look at Germany real quick. Germany's still holding this trend line. We've been watching this now for quite a while. We're still holding this trend line. The moving averages are curling up. Looks like Germany wants to go up into this area, this 34 area. So we'll keep our eye on that. I'd say that's actually, let me show you where a good trade entry would have been. Right here, we had a low. We had an acceleration away from the low. We had a pullback to a higher low, and then a close this week above this high. I'm hoping everybody can see that. Let me zoom in a little bit more, because this is kind of this way of doing this is not it's not like magic, or it's not set in stone or anything. But you can see that there's a low here, okay, and then you can see there's a low here, and this low here is higher than this low. And then we have this pullback, and then you can see here we had a close above the high of this low week, okay, right here. So now, depending on what your rules are, you might have to wait for a close, which would be right here, or you could enter right here. The close is a safer entry, but there's more risk. The risk is from right here all the way down to below here somewhere. Okay, so there's the risk, and the reward is whatever. But you could also do it. You could enter as soon as it breached this high right here, in which case your risk would be something more like, whoops, that's ugly. And there we go. Your risk would look something more like from this line to this line right here, this distance here. So hopefully that's not confusing. I drew maybe more lines on the chart than I needed to. But suffice it to say, Germany has had a move up. It's had a pullback. Whoops, sorry about that. It's had a pullback, and now it's lifting. It's been lifting for the last several weeks, and it's holding this trend line. So we would expect Germany to continue higher from here. We've also been looking at the UK. The UK, I was expecting it to go to this resistance area here. It didn't quite make it. It still could make it. Notice that we have a higher low here, a higher low than this low here. So we could get a move up into this area before the UK rolls back over and comes down. But clearly the trend has been broken, and at the very least we're going to get some just some sideways action in the UK market at a minimum. I mean, it might go down, it might go up, but in the very least it's going to move sideways. The odds are that it continues down, because this move has made a series of lower highs and lower lows, and the rally has been pretty tepid. So Japan, broke out of that range a few weeks ago now. It's made a move out. It's pulled back. It's rallying. I would expect Japan to continue to move up into this area up here. For those of you trading Japan, or you're invested in Japan, that is the FXY, I believe. So this one is the EWJ. So you can own the EWJ, or I think it's the FXY. Let's look at the FXY and see if it looks similar. No, the FXY is the currency. So I stand corrected. Don't listen to that. That's really about it for those charts. Let's look over here. Look at the DAX on NinjaTrader, and you can see the DAX is still really strong, well outside the target area for this DP. A lot of times, and this is just because I've looked at charts forever, but a lot of times once you have this last series of red candles, you're talking about getting, a break above this high. So if there were a pivot here, we could take a DP off, and it would probably put the box somewhere in this area here. So I would look for the DAX to move into that area. Let's look at gold. Where's my? I guess I changed the chart on gold. Let's look at the weekly. Sorry about this. I should have already had it up. Should take me a second. Yeah, so we had this downtrend line on the weekly in green. I'm sure most of you recall this. You can see it here in green. We broke out of that downtrend line, and we went over this in detail about this pullback and how the rules I just showed you for the entry on the German market would be the same here. Now, I was going to enter this trade, but never did. I was waiting. I was looking for a little pullback because I don't like taking as much risk. So let me zoom in a little bit here. This is not the greatest picture. Let me just go to a daily. Look at it on a daily. So a lot of times what will happen is you can once it takes out, and I don't know where the end of the week was. It was probably like right here at 1185. And then, of course, it kept going up. So I was waiting for it to pull back, but I was looking for, something that looked more like an ABC, something that kind of, here, let me see. Something that looked like this. So I was waiting for a little bounce, and maybe we're still going to get that. Maybe gold will bounce next week and then pull back into this box, in which case that would be a good area to buy gold. And if it gets there, I will try to buy gold again. I'd really like for it to get down even lower, like in this area down here. But I'll just have to wait and see what gold does. But I was going to buy gold for our group here, and then we were going to trade it up into this blue box area up here. But that has not happened yet, so I can't show you that trade. Let's look at crude oil. Crude oil is still very much in the news. We're looking for crude oil. It's just kind of chopping around here sideways, but we're looking, eventually it will break out of this range between these lows and this high. And once it does, it's probably going to move into this area around $70 or so. And that might start happening next week or the week after that. So we'll keep an eye on that as well. We've already looked at the euro US dollar. Here's the future on the euro. And you can see that there's a lot of strength on the STF here. And that usually portends something. There might be a bounce here, something that looks like a bounce up, and then probably a lower low. So the euro is probably going lower. That's what this strength area, when you see these bars outside this band right here, you can see this band here. It usually means you might get a bounce, but that bounce quickly going to be sold off, and you will get a lower low. So look for that to happen on the euro. Euro's not ready. We're not ready to go long the euro yet, so stay out of that market. Let's look at bonds real quick. You can see the rally here in bonds, and you can see that I've got a 1, 2, 3, 4, and I'm waiting for a 5. If you project 5 up, it's probably right around here where this DP would be, somewhere in this area. So we're looking for Treasury notes to move up into this area. So we could get still a lower low in Treasury notes. the yields kind of look different than the notes, so we'll just have to see how that plays out. I don't expect a new low in yields, though. Just a low that's lower than this one, which in this case it's a high. So we're expecting a high above this high, but that's not a new high. If you go back here, there's a high higher than that. So we're not expecting a new high in this market. All right, so I wanted to do something. I wanted to add a little something here really quick for you guys. You're going to start hearing more and more about inflation and deflation. So real quick, I want to define those two terms for everybody, and feel free to go check this. Anything I say, you should check it out for yourself. Don't just take my word for it. I'm just trying to call your attention to it. But inflation is the definition of inflation is the expansion of money and credit in the economy. Okay? Now I know we talk about inflation being rise in prices. That's the result of inflation. The actual act of inflation, or what inflation is actually defined as, is the expansion of the money supply and the expansion of credit. And these two things go hand in hand. When you have an expansion in credit, because of our banking system, our fractional banking system, you get an expansion of the money supply. Now, we've had an expansion of the money supply over and above our expansion of credit. But basically, those two go hand in hand when you're talking about inflation. And now I'm going to read something to you out of the January Elliott Wave Theorist, where they talk about deflation. This is another term that's misunderstood in the market, and I think they capture it really well here in this little paragraph. So it says, deflation is not a period of generally falling prices. It is a period of contraction in the total amount of money plus credit. Falling prices in an environment of stable money is indeed a good thing. In fact, in a real money system, it is the norm because technology makes things cheaper to produce. But when debt expands faster than production, it becomes overblown and then wiped out, and prices rise and fall in response. So what they're saying is when you expand the money supply and expand credit, and you expand those two variables faster than you expand production, okay? So see the people that on the news, they have it kind of backwards. They think that we need to go out and spend more money, but what we actually need to do is we need to produce more goods and services that we can then sell to the rest of the world. But when we expand the money supply and we expand credit faster than production expands, then you get an inflationary environment. Okay, that's inflation. And that inflation leads to an inflationary environment like you hear on TV where they talk about rising prices. A deflationary environment is a situation where credit is expanded too fast and people take too much risk, and there's a wave of defaults and things like that that lead to the wiping out of credit. And when you wipe out credit, money contracts. Okay, the money goes away, it just disappears from the economy. That's what deflation is. Generally falling prices over time, which is not deflation, that's just falling prices over time. What they're saying there is that's due to productivity gains and technology. So it could be because, if you're loading boxes by hand and it takes 100 guys to do it, and then somebody invents a forklift, and now all of a sudden it takes 10 guys to do it on 10 forklifts, that's a gain in productivity through the use of technology, and we experience that in gains in productivity, which lead to a higher standard of living. That's how the economy works. Now, what I wanted to do is I wanted to play a short video because these guys are talking, and this is another thing from Elliott Wave, but they talk about the spread between junk bonds, so they call it high yield, you might hear it called high yield, and the spread between high yield and U.S. Treasuries. So I just want to play this real quick, I think you'll get a lot out of it.
The indicator from the 2007 market top flashes a warning now. I'm Bob Stokes reporting for Elliott Wave International. High-yield bonds are called junk because they receive low credit ratings. These securities have a higher risk of default than less risky bonds, such as U.S. Treasuries. But when investors feel confident about the future, they suppose the risk of default is low. Conversely, when investors feel bearish, they anticipate a greater risk and demand a higher yield. Thus, a widening yield spread between junk and Treasury indicates a rise in investor fear. This can be a prelude to a downturn in the stock market. That's what happened in 2007. Consider this chart from the December 2014 Elliott Wave financial forecast. Quote, the graph shows that after the junk spread narrowed to a record low 2.33%, it reversed in May 2007 and started to widen. In other words, as the stock market rallied to its final high in October 2007, bond investors' psychology had already shifted from risk on to risk off. It foretold of the impending reversal in stocks. The divergence lasted 5 months and was followed by a 54% decline in the Dow. End quote. Here's what's relevant now. A similar divergence has unfolded in the junk debt to Treasury debt yield spread since June. This divergence has lasted longer than 2007. The December financial forecast noted, quote, a key bull market cohort has abandoned the Dow, showing an intensifying loss of nerve on the part of bond investors. Our view is that it carries the same message as it did in 2007, end quote. Since that commentary published, the stock market has turned increasingly volatile. For example, on January 13th, trading volume picked up as all 3 of the major indexes fell from session highs and closed in negative territory. The recently published January financial forecast updates you on the junk to Treasury spread and observes, quote, we have been virtually alone in discussing this danger ahead signal, end quote. We have other financial insights that we would be delighted to share with you. You can get them 100% free as you...
Okay, so they're just doing a little commercial there on their website, and this is it here, Elliott Wave International. You can go to elliottwave.com. They have some free resources. They have some stuff you can podcast if you're interested. Elliott Wave is just it's a way of forecasting markets, and it works pretty good, especially in the very long term. The very long-term type forecast. So this is what they were just talking about. So this is the Barclays U.S. corporate high yield spread. So notice right now the spread, the low for the spread was down here, around 3, and then we had this kind of pattern. You can see they've marked it out for you: 1, 2, 3, 4, 5, and then you've had this pullback. And we've talked about this before. If this is the first move out, and this is the first pullback, then this is going to be a very large move, and this spread is going to widen very rapidly, and this creates financial stress in the marketplace, okay? This creates stress when this moves quickly and people aren't expecting it. They have these securities that they're holding, maybe they're selling derivatives against, and all kinds of things like that, and when these spreads move quickly, it creates financial stress in our banking system. So just be aware of this. The other thing I wanted to point out, these are both in the which one is this? I think this is the April 2015 financial forecast. The other thing they pointed out is we've talked about margin debt before on this YouTube channel. But what they did is they kind of teased something out that's a little bit more telling than just margin debt itself. It's the margin debt to GDP ratio. So let me scoot this down so you can see it. So we're looking at this graph right here, and what they did is they took margin debt and divided by the GDP, And you can see that in 2000 we were here, 2007 we were here, and you can see here in this most recent run-up, well, this was 2000. I'm not sure what I'm looking at there now. I think they meant to say 2014 or 15 here, but if I read through here real quick, you can kind of get the big picture. It says this chart shows NYSE margin debt as a percentage of U.S. GDP at 27.3%, which is the February 2000 peak. It is right in line with the peaks in March 2000 at 27.8 and July 2007 at 26.4. After both of these tops, the Dow Jones Industrial Average climbed 39% and 54% respectively. As the inset on the chart shows, investors are pulling back from their leveraged positions similar to the prior peaks. And so what they're talking about is they're showing you kind of a close-up of this right here. This is investors pulling back from these leveraged positions. So this is just evidence underneath the market that shows things happening in the background that we need to be aware of as investors. Now, most people aren't looking at these things, and once they become obvious, then the markets start moving very, very rapidly. So that's where we want to keep you, the average middle-class investor, out of the way. Think of it as a train rolling down the track, and you want to be able to step off those tracks before the train runs you over. So that's kind of what we're up to here. This is what on NinjaTrader, this is what this looks like. We had a decision point trade here that didn't work out. We've had another one here. It's still active. The target on this should just be just below this low here. Yeah, so down here at now these are futures, the ES futures. So 1947 or so. So I think this is a key area here. This around the going back to the S&P 500. The key area is this area right below here, 2044. I think if we break these lows, we're probably coming all the way down to here and maybe all the way down to here. So the DP on the futures for MT Predictor is saying that we could be coming. Notice this DP right here is right in line with the target on the DP signal from NinjaTrader around 1940, 1950. So I would say if we break 2044, we're going to make a lower low. We're going to come below this low here. And you're probably going to hear a lot about, oh, this is the pullback we needed. And it may be so, okay? But if it comes up here and then makes a lower low still, this move here is going to be quite substantial. So we just need to keep an eye. We're going to keep an eye out for that potential event for everybody and make sure that we at least warn everybody. Okay. Now, if you've got your own strategy and you want to stay in the market and everything, that's great. The other thing I would say about this high yield stuff is you might have some junk bond type mutual funds in your 401k IRA, and this is why when we look at the interest rate, this is why we're focused so heavily on that, because really the most important interest rate in the market is the U.S. 10-year Treasury rate, which is what we've been following here. And so if this takes out this trend line, I'm going to tell you right now, you do not, if it does one of those, you do not want to be in any kind of bond fund in your 401k or IRA. Now, if you want to wait, I think it's probably prudent to wait for this line to be broken. There's nothing wrong with that. But if you feel pretty good about this forecast, I mean, here again, what could you gain? You can gain, I think, maybe down to there. I mean, that's probably as far as the yields are going to fall. But that's almost, let's see, this distance here, from here to here, it's about equal from here to here. So right now it's a 1-to-1 kind of a risk because we're right in the middle of where this could go. This could go up and break out, which in case you want to be out, or it could come down here and make it lower, in which case you'll make more money on your bond funds. So right now it's a 50-50 kind of proposition. So there's not really much to do there. So I mean, you could stay in or you could get out. It doesn't really matter. Now we are showing that the Williams is about halfway down. Probably roll down here to the oversold area and then turn back up and go up, which is probably when this will turn back up and go up. That's it this week, everybody. I ran a little long. Apologize for that. I felt it was important to show you the video and talk about inflation and deflation, and then show you the junk yield to treasury spread, which is pretty important, and then this leveraged to GDP, margin debt to GDP ratio, which was pretty telling in the last two major tops that financial markets experienced. So anyway, I hope that was good this week. Certainly comment if you like, and coach me in a direction if you want to go to another direction, or just comment just whatever you have to say. Hopefully this week I'll get into that gold position and we can start looking at that. I think it'd be kind of interesting for the class. I say class. This is not really a class, but for the channel here to kind of follow a trade, and gold I think is one of those that could be fun to follow. Now once this starts to roll over and come out of this, we'll probably enter some positions on this too. There's some short positions, or probably what we'll do is we'll just enter the SDS. This is the SDS, so when the market goes down, the SDS goes up. Okay? All right, everybody. Take care. Enjoy your Easter. We got Good Friday tomorrow and Easter Sunday on Sunday. And probably the most important religious holiday for Christians around the world. So enjoy that with your family. And hopefully you can remember what that's all about. Okay? Take care, everybody. Bye-bye.